Quick introduction, I'm Alan Pichatello. I'm the Director of Product at Blockstream. I work primarily on Liquid, but we have a lot of other products that we work on. So we have Green Wallet, we have satellite service, we work on the Lightning Network, we do some work on Bitcoin. So we're busy with a lot of things. We're going to have another session right after this as well, talking more in depth about some of the technical ways you can use Liquid. And my talk's going to be more specific about Liquid and how it's set up to not be an illusion of a blockchain. So I'll jump in here. Just quick background. I joined Blockstream about 2 years ago, and I've been working on Liquid, getting that launched. We launched Liquid in October of last year, and so it's been up about, about 7 or 8 months now. And is anyone here, I know some people are here familiar with Liquid. Is anyone not familiar with Liquid? I'm figured that'll be a couple hands. All right, so Liquid is a federated sidechain of Bitcoin. So what that means is you can take Bitcoin and you can move it into this network. And one of the things you can also do is issue and create other assets to be traded upon. So you can do things like stable coins or security tokens. And all of this is done with extra features that are not possible in Bitcoin. All right, so I'm going to give a little quick recap of Liquid in a little bit more detail. I'm going to talk specifically about security tokens and their challenges. And a lot of solutions that are out there really are on blockchains, and sometimes they're for good reasons, and sometimes they're for dubious reasons. And we're going to talk about why this would necessarily apply for Liquid. So the first part of the talk we're going to do, I'm going to be up here, and then we're going to do a kind of a more in-depth hands-on version where you laptops out and you can actually use Liquid in your own hands. So just to recap, Liquid's a sidechain of Bitcoin. It lets you do something called a peg, where Bitcoin get frozen and held by the Federation members. These are 15 different exchanges and market makers and OTC desks and financial institutions that operate these computers that basically will work as a giant multi-sig distributed around the world wallet. And they also do another function where they actually create blocks on a different blockchain. So Liquid is more centralized than Bitcoin. You're going to have 15 members, and what it requires is at least 11 of them to be functioning to work, and at least 5 of them to be honest to allow security so that no one can steal any of the funds. So you peg the Bitcoin in. You can now use it on Liquid and do other things that you couldn't do otherwise, and then you can move it back out onto the Bitcoin network. So the main features that we have on Liquid are something called confidential transactions, and we also have 1-minute signed blocks. So this is kind of a very advantageous thing for trading applications. Whenever you're moving funds between different exchanges, you may have to wait for a Bitcoin block, or depending on how much you're transferring, they may require 6 blocks. And mining is probabilistic. So this means you could get a block in the next minute, you could get a block in 10 minutes, it might take 3 hours to get a block. So if you're trying to trade and you have to wait 3 hours to get your money moved, you might have missed that opportunity. So Liquid changes the trust model a little bit, but gives you the advantage of you're getting your funds settled in 2 minutes. There's also the other feature of confidential assets, and this is what we're going to get into a little bit more. So confidential transactions means when I send funds, no one can see the amounts that I'm sending. So I could actually send a transaction, and everyone can validate that it actually has the amount sent is the amount received, but they have no idea how much that is. And so if you want to get into the more weeds of that, will be in the next talk. But an initial added on part of that is something called confidential assets. So this means when I send, because Liquid is a multi-asset chain, I don't just send Bitcoin. I could send, I could create a token of my own. And when I send it, no one even knows what I'm sending. So if let's just say I have a US dollar coin on Liquid, and I have Bitcoin on Liquid. To an observer from the outside, they don't know what I'm sending or how much. And all this is done where anyone can actually validate what's going on. So that's the quick 2 to 3 minute recap of what Liquid actually is. So again, it's 15 different members run the network. It's different security than Bitcoin. But we're going to plan for changes this year to make it what's called a dynamic federation. So this is going to be allowing new members to leave or join the network, depending on how much they're using it, or if new people get interested and want to join. So this 15 is just kind of this initial period. All right, so some key differences of Liquid gets compared a lot to a lot of these other blockchains that have assets, or non-blockchains that also do asset support. So what are some key differences with Liquid compared to other platforms that exist? So Liquid is based on the Bitcoin source code. So we basically took Bitcoin, added on extra features that we needed to support assets, to support the confidential transactions, and we can now stay up to date with all of that peer review, all of that, all those eyeballs looking on all that Bitcoin code. So Bitcoin is by far the most secure, most stable blockchain out there, and we can leverage a lot of that work that's being done. So we also have a scripting language that's very close to Bitcoin. So basically we took the Bitcoin scripting language, which is more limited in a lot of ways. We added a couple of operations that were disabled originally in Bitcoin, and so that's the model of Liquid. And so, this is compared a lot to the kind of Turing-complete smart contracts that exist out there. But in that reality, what sounds like a feature that you can do all these powerful things sometimes becomes a hindrance, because you can look at this complex contract and have no idea what is actually happening. Whereas with Bitcoin scripting, you can actually look at the script and very easily, and especially with some addition of some new features like Miniscript, look at what it's doing and make sure, if I'm spending coins, I want to make sure that it's going to require 3 of my board members to sign off on it. If I had a smart contract to do that, it's almost impossible to audit that. But with a Bitcoin script, I can very quickly see that, yes, those keys are in there, and yes, it requires those in all those cases. So that's a kind of a big difference there that kind of seems like an anti-feature, but is actually, I would say, one of the most strong features of Bitcoin and Liquid. The other part is that assets are actually native at the consensus layer. So what this means is, with the assets are built in. So when you have your wallet, it actually detects that you received or sent liquid assets. Versus a smart contract system where the assets only exist because you're updating variables on a balance. So you're getting all of the kind of native features right off the bat that the assets are actually there. This can allow you to do things like SPV type wallets on Liquid, where you could actually just look at, as long as you trust the federation to operate, and that it's creating blocks, you can verify that they've signed all the blocks and that the transactions are there and you've received them in your wallet. So if you wanted to do a light wallet, some of those applications would be a lot easier versus other systems where you may have to rely on more trusted nodes. And the other big difference in Liquid, and this is, we designed the system with the intent of being a serious financial system. Privacy is really important here. And the way we look at privacy, a lot of people kind of see it as, I'm trying to hide information. I don't want to, I'm being secretive because I'm doing something I shouldn't be. But really, privacy is a key component of the financial system. And sometimes that's at odds with another key component of financial systems, which is auditability and verifiability. So if privacy really isn't about hiding information, but choosing who you share it with. So if I can take the information about what I've done, and I can prove to any auditor or any regulator, this is exactly what I've done, and they can actually independently verify that I gave them the correct information, and that's actually what happened. But all of my competitors, they don't know what my deals were, they don't know how much money I have, my landlord doesn't know how much I'm earning as income, so they can't jack up my rent. So privacy is a really important part for this financial system, and we've really built it in, but still maintaining that compatibility with audit. All right, so now I'm going to dive a little bit more into some very specific parts of security tokens and regulated assets. So we've kind of seen a real transition over the years. The first kind of assets that were created out there, where I'd say on the stablecoin front, you were seeing more security tokens of, someone's trying to bust their way in here. And then we saw kind of a move towards more of the ICO tokens, where anyone could just send them any way they want. But when that reality is, a lot of these, there's been crackdowns on a lot of these things, and anyone who's going to do this as a serious offering needs to make sure they're compliant. It's kind of, if you're trying to do something decentralized, but you have an address and you have a team that you can go after, you better be compliant. You better be making sure you're actually following these restrictions. So just some examples. For security tokens that are out there, different regulations that you have apply may restrict who can own them. So maybe you don't want anyone in the US to own these tokens. Maybe you only want people who are qualified investors to own the tokens. You might have restrictions about who can transfer the tokens or where they can go. So you might have a lockup restriction where they can't be transferred for 12 months. You might have a restriction where if I'm in the US, I can only receive the token from someone who's also in the US. And then there's some other additional requirements that are usually in here. You may have voting. So if you have a stock on the blockchain, there may be voting rights of the shareholders. There may be dividends. And so really how we approach this is a lot different than other blockchains. So first thing to understand, and this is where the challenge is, there's a lot of things I said done on blockchain that make no sense, or they're done just to do it that way. And so you really have to understand what a blockchain is really good at. And so what we have here, fungibility is very important. If it has a strength here, the other strength is validating ownership and solving the double spend problem. So if I receive a share of something, I want to make sure it's actually came from the issuer and it's legit and it's not, if I'm doing a stock certificate, someone could make a forgery and I don't know it's real or fake. Something on the blockchain, you can actually trace it back that it was created, there were this many shares, and I can actually prove that it's actually there. And because it's a digital asset, you want to make sure you didn't send it to two people. The other strength of a blockchain typically is there's no trusted third party. This is not necessarily something that's very important for a security token. So securities they always have some trusted third party, which is the issuer of the token. So if I'm Apple and I sell you shares of my stock, you're going to have to trust me that I'm going to pay out my dividends to you. And if I don't, you could probably come after me and sue me for that. So that's OK. We don't need to necessarily solve the trusted third party problem, but we can solve the problem where there's not other trusted third parties. So if we're trying to trade these assets, or if we have to have a custodian, or we have to have some type of escrow agent for transfers, or clearinghouses, a lot of those problems can be solved on the blockchain. And then censorship resistance. This is another key strength of a blockchain. And really, that's not necessarily something we care too much about in this case, because the issuer, or any jurisdiction of the issuer could potentially censor my ownership of an asset. So if I acquired an asset and I wasn't supposed to get it, it's possible the issuer could be compelled to lock that asset up so that I couldn't transfer it. And so that's something we don't need to solve. So this is the key part where, how are we going to solve this problem? We really need to look at what problems we're solving here. So what are the weaknesses of blockchains here? So one of the key weaknesses we have is scalability. Blockchains simply don't scale, at least at that base layer. And the only way they do scale is by imposing a lot of costs on someone or letting them just not validate it. And if you're not validating it, why are you using a blockchain? You could have just trusted whoever's telling you the information anyway. Some blockchains have the weakness of privacy. So there's all this information that's out there. And if they don't have privacy built in, everything that's going on is being recorded and logged, and someone can dissect that information. So if I'm doing a lot of trades of assets, someone could maybe piece that together and figure out what my strategy is and either duplicate it or front run me or get other information that I maybe didn't want to disclose. And then another part is just kind of usability. So the usability of blockchains, they tend to be a little clunkier. They're going to be harder. You have to wait for things to settle. Maybe there's a block. Maybe there isn't a block. And that's where you get some uncertainty there. So for security tokens restrictions, what we're really going for here is, building, when you do an on-chain enforcement approach, this is kind of the traditional approach that a lot of platforms are using today. You start out, you write a smart contract, you have all these procedures of everything that you actually want to have for that token, and it's written into the blockchain. And it's relying on all this other information from the outside, because a blockchain can only really know about things that are on a blockchain. They don't know the temperature outside. They don't know if the person transacting is in the US or if they're in Canada or Europe. They don't know if that person's a qualified investor. They don't know if they're on some terrorist watch list that they can't transfer this asset. So all that information needs to be baked into the blockchain now. So now we not just have these restrictions, but now we actually have to have someone from the outside world going in, whitelisting these addresses, trying to figure out what's going on, and now you're just tinkering with all this information that's actually coming from off the blockchain. And is your on-chain enforcement actually on-chain at that point? It's actually really just coming from the outside world. So when you're doing transfer restrictions, You're updating this based on, rules change, laws change. Every time you do that, you need to update that smart contract with something new that's going to reflect all of those new changes. And you need to replace all the rules. And you better not have any bugs in that, because once it's out there and deployed, you're going to have a hard time, undoing things that are in there. So the other approach, so the other parts too. So you also have like voting. This is another challenge you have. All this information is being logged for eternity, and every person who's using your blockchain is going to need to validate it, even if they don't care anything about your token. So you do voting, you add a procedure. You say, okay, you vote, we'll log your votes, and if you actually reply, we'll sum it up and make a decision based on this vote. But the only people who care about that voting are the people who actually own that token and the issuer itself. So that doesn't necessarily gain anything by being on the chain. And then if you want to pay dividends, you could put a procedure in there and say, pay dividend, and everyone's balances go up, or they send them, a different asset. It's restricted to making these payments to on-chain assets because you don't necessarily know who they are or who owns it. So that limits you a lot of ways. Maybe some investors are not particularly blockchain savvy, and now they're kind of cut out of being able to really invest in this.
Do miners compensated for this stuff, or
For Liquid?
Yeah.
So Liquid is federated system. Yeah. All right. So I had to bring out Office Space in here. So if you're doing this smart contract and it's doing all this enforcement, what are you actually doing? You're just bringing all this information that was collected somewhere else and making everyone have to log it and record it and download it. And it's just really coming from the outside world anyway. So, we then have, he takes the changes from the engineers and he updates the rules on the blockchain. He's not actually doing anything. I don't know if anyone's familiar with Office Space, but he took the requirements from the engineers and talked to the customers. But sometimes they would get them directly from the customers anyway. It's kind of useless. All right, so how are we going to actually solve this? What is the benefit? I'm not going to just say everything's terrible with these smart contracts, but what are the benefits that we actually have here? So the enforcement of the authorized rules are separated from the person who's creating them. So you could basically, someone could develop this, hand it off to you and say, good luck with this, hands off, I'm not touching this anymore. I am not involved in this security. Please, regulators, don't come after me. I just wrote some code. And you can hand it off to the issuer of the contract, and they can do that. Well, the problem is someone has the power to change those rules at any point in time. So if you're trying to just dodge a regulator coming at you, if you're the consultant or something that's writing some code, you might be okay, but someone's still going to be targeted for that. And then you also have the idea that there's, are you able to hide from the regulators with this? Well, maybe. It's a lot of stuff that's still being discovered right now. People are saying, well, we're not doing anything, and if everyone's trying to point fingers at everyone else, maybe they confuse the regulators enough that you're not going to get targeted here. All right. So for Liquid in general, how we're recommending people use security tokens is to do a completely different approach, where it's going to be kind of off-chain enforcement. So this idea is you have, really line up with those strengths of the blockchain and don't care about the weaknesses. So in that place, why do we care about the blockchain? We want it to be audited. We want everyone to be able to verify that what's in there is correct, and we want to honor people's privacy. And we can actually do all of those things without putting any of this information on the blockchain. So we want to avoid the blockchain where we don't have those strengths. So anything that there's logic that only one person cares about, let's just leave it between those parties to deal with that. The enforcement logic, if I want to, if I'm an issuer and all of a sudden, the SEC comes out with a new regulation and I need to comply with this, it's going to be really hard. I need to go find a smart contract developer and go write some code. You can now structure this in any programming language, any environment where it's authorizing these transactions. Transfer logic, this is all something that's fairly simple that only a couple people care about. Communications with the central party. So if we are just talking about voting, the only people who care about that voting is the issuer and the owners of the assets. And as long as they can prove that they're not cheating the voting, you can use a lot of cryptographic proofs that you own the asset, and you can submit these votes. And the issuer can prove these were the votes I received and prove that they're correct. everyone knows that it's a fair system, and the only people that need to know about that are the ones that are involved. So we're going to avoid a lot of the pain points of blockchains. I know a lot of people like to ignore, blockchains are magic, they can solve everything, but they do cause a lot of pain, and that they're very costly and expensive if you don't use it right. So we kind of have, this is kind of how I view the two approaches. So we can just keep everything off the chain, or we can update the smart contract because it's better because it's on chain and it's a smart contract, except when we do the whitelist, and except when we need to update the contract, and it's totally decentralized and it's actually this fancy smart contract. And this is kind of a overkill for solving a problem that doesn't need to be solved. So I think that's kind of the main takeaway, I'd say, of the off-chain approach, and why doing things in liquid and with simpler contracts is going to be a lot easier.
What do you make auditable?
What's that? So if I want to, let's just say I'm a investor, and I need to prove, like an institutional investor, and I need to prove that I actually own this much shares on behalf of a client. I could prove that I own exactly the amount of shares that I claim I do. So that would be auditable, that I received them. I can prove that when I did a transaction to someone, how much I spent for them. So if I traded a liquid Bitcoin for an asset, I could prove that type of information. So anything.
Other exchanges have been doing this for almost 2 decades. What's your advantage?
For
not blockchain. The old world exchanges were dematerialized assets are there tracked, who owns what, who's been purchasing what. So what's the exact advantage?
Yeah, so this is you're relying on.
Availability versus the other.
Well, you're relying on a third party to have said this is what it actually is. So how do you know that those records are valid, right? How do I know that this has actually happened? So if you actually have it on the blockchain, those things are all things that can be cryptographically proven, that they did exist at these points in time, and these were the transfers and settlement. So I think we'll have some more time for questions at the end too, so I got a couple more slides just to power through here. So how do we actually do this? Then this is the last part, is we do this concept called the Authorizer. So this is something that's going to act as a cosigner on transactions based on whatever the rules are that are enforced. So we're very fortunate. We also have, the next speaker is Lawrence Nahum. He's the creator of Blockstream Green. And Blockstream Green is a Bitcoin wallet that can cosign Bitcoin transactions to enable things such as spending limits or requiring a two-factor authentication. So if you want to spend your Bitcoin off your phone, you want to make sure that it does a Google two-factor authentication so that someone just can't steal your keys. Or even a feature that he had in there as well was a trusted double spend protection. So you have a cosigner that will only sign something once, so that you make sure that a merchant accepting that knows it won't be double spent. So this has already kind of been done before. This is, when did you create Blockstream Green? 2014, 2013? It's been a while.
Starting 2012, I think 2013 was live.
So 2013, he was live with Green Address, was the original product. And we've already been doing this for a long time. And this can be extended very easily to the idea of a security token. So all we need to do with that is rely on this authorizer, or a set of authorizers who are enforcing this logic. And they can have someone co-sign the transaction based on what their results are. So anyone can, this authorizer can outsource this logic to any other parties they need. You might have different KYC providers or different verifiers of that this is actually going to happen. Then you're going to have the authorizer co-sign that transaction and ensure that the destinations match all the restrictions. So it's going to happen or it's not. You're relying on this issuer-defined transfer agent to authorize it or not, and the transaction happens. All right, so how does this work? You register it when you create the asset with it, and it's going to know, this is the asset I care about. I'm only going to let this transact when it's time. So if Alice wants to send her token to Bob, her wallet constructs a transaction, says I want to send this information, and shares parts of that transaction, the parts involving that token, for the authorizer to co-sign. The authorizer can then check those rules, make a summary of what's actually happening, and sign it or not sign it. Once it's signed, the transaction is valid and can be broadcast. So now we have a full transfer restriction, no smart contract, all the rules enforced, compliant token with little headache and full auditability. So why is this a big advantage here? The real thing here is you have lower fees for execution. This has been a problem I've seen with a lot of the kind of more heavy security tokens where you have high fees or gas rates, because every time you want to update this contract, you're having to move data to the blockchain. Every time you update who is authorized to hold this token, more fees. This is something that just executes, and it's just a single transaction. Then we have privacy from outsiders. And so if you can do this, you can actually, no one else knows necessarily what's going on. Maybe if you were put in this list of high net worth individuals, that's put you as a target. You have reduced chances of bugs, enforcement logic, and you also have the ability to respond quickly to changing requirements. So this is all advantages of just being able to handle all this logic kind of the old-fashioned way while still taking advantages of the blockchain. So I think we have a little bit of time left for questions if you want. And then we also, just as a reminder, if you want to actually use Liquid and get into the nuts and bolts of how this works, we have a hands-on session afterwards. So if you have your laptops, we can get that going. And if there are any questions, we can. There's one right there. He's got a microphone. She's got a microphone right behind you, so everyone can hear.
So I have two questions. One is there a native token on the Liquid chain which pays for transaction fees?
Yeah, so that's based on the Liquid Bitcoin token. So for every Bitcoin that is put into the network, it's a Liquid Bitcoin can be created. And then you can convert it back. And so it's basically paying in Bitcoin, but it's slight different token.
I see. And the second is, just a comparison. On Ethereum, I mean, you could do the exact same thing, just with lesser smart contract logic. But so you're saying the advantage of this is that lower fees, and it would be private? Are those the two? You get the privacy. You do still have to do the smart contract on Ethereum just to do the basic ERC20 token that does need to exist and updating balances that way. But yeah, you're definitely revealing everything when you're doing any kind of transfer of this, because when you do the transfer, let's just say I'm trying to trade this on a decentralized exchange or something. Everyone's seeing that information. The miners can front run it. That's kind of, I think, the privacy aspect that you get in there that you wouldn't have otherwise. So lower fees and privacy would be the benefit.
I would say those are the biggest ones. And just stability as well. Ethereum's had a lot of things where you do things like multi-signature wallets, and they black holed $200 million. So this is something that's natively built into Liquid based on the Bitcoin model. If you want to do multi-signature transactions, it's an operation. Whereas with Ethereum, you had to write a smart contract just to do something as simple as multi-signatures. And if you do it wrong, you lose money. And unless the important people lose money, it's not going to get fixed. Over there.
So trying to understand the security model a little bit better. So you said you started with the Bitcoin code base. So I presume you removed the miners completely and replaced them with the federation. And your blocks are 1 minute blocks. So does it mean they're settled finally after that first settlement is done, since there's no mining?
Yeah, so it actually requires 2 blocks. And that's just a subtle detail here is there could be some miscommunications of the miners where the signing of the blocks is done with a separate key module. And it has some basic logic on it for block signing and for monitoring transaction, for paying the Bitcoin. So for the block signing, it will make sure that if it signs a block, it's not going to reorganize its parent. And the reason for that is if there's a miscommunication and I signed a block and now I refuse to replace that block, we're going to be stuck forever. So we have to allow the tip of the chain to change as long as it has the same parent. So once you have 2 blocks, then it's final.
Okay, so 2 blocks, basically in 2 minutes you get final settlement.
That's correct.
That's interesting. And then in the Bitcoin security model, we have the miners, but we also have people who run full nodes, right? Is there such a notion in Liquid of people that are running full Liquid nodes with the entire history of all transactions?
Absolutely. So it's the full nodes, the same concept. Everyone can run a full node. There's bridges into the network that you can receive these blocks. and validate them all completely. So it is a little bit more CPU intensive because you're validating all these confidential transactions that are happening, but there's still something that's validated. And I have a full node on this laptop that's running off the Liquid network, validating everything that's going on. So it's not very resource intensive.
You can even run it on a mobile.
He's running on mobile, you got it on your phone?
Well, yeah.
Okay, so how does that relate to scaling then? So because let's say this becomes wildly popular, and we have all kinds of assets issued on this blockchain. Let's say a bunch of security assets, maybe utility tokens, so forth. If everybody's using this, we have a lot of transactions. That's a lot of stuff that's being put into this blockchain. If we're expecting people to run full nodes and keep the entire history, how do you deal with this?
All right, so there's actually you kind of set me up here for something that I wasn't planning to talk about, but it's a good opportunity. So yeah, definitely because so much of it is, you're basically doing settlement and creation of assets on chain. That's pretty simple, and you can still do any kind of off-chain approach. Now, because Liquid is built on top of Bitcoin, you can do a lot of the same techniques you can do on Bitcoin. So where I'm going with this is one of the scaling techniques for Bitcoin is Lightning Network. This is also something that Blockstream's working on. So this means that it's pretty simple to convert the Lightning Network to run on top of all these assets for scaling. So if you have any super transaction-heavy asset, a lot of these security tokens settle infrequently. But other assets, stable coins, may have desires to be moved more frequently. You could set up a Lightning Network of, let's just say, Tether on top of Liquid, and now you have much higher scaling properties. So the idea is to put the most valuable settlement on chain and try to take as much of the other logic off chain. So that's actually possible to do.
That's wonderful. So my final question is, when we create a new asset, which is completely unrelated to Bitcoin, do we need to peg some Bitcoin from the main chain into Liquid, or can this exist completely independently of any BTC?
You will need to have some to pay transaction fees. So you can either peg it in, anyone can peg in Bitcoin. There is a restriction on pegging out Bitcoin, for security reasons, that it needs to only, they'll only sign it if they're knowing it's going to a known party. We'll improve that with some time as well. There's some really good ideas that the team has for how to improve that. But you will need Liquid Bitcoin, either peg it in yourself permissionlessly. We'll talk about how that's done in the next session too. Okay. And or you could get it off an exchange. There's exchanges that you could withdraw Liquid Bitcoin from as well. So
whoever is creating the asset, the new tokens, prepays for transactions with some Bitcoin that they peg in?
Basically, that's correct. They have a wallet, and as they go, they can spend that Liquid Bitcoin.
This sounds really exciting, guys. Okay. Well done.
Any other questions? All right, we'll get a short break, and then Lawrence will be up next with building on Liquid. So if you have your laptops, we can get your Liquid nodes, and you can actually create your own asset in the next session.